Samir is working at a tech firm based in Bangalore, and his long-standing dream of working in the US is finally coming true. He recently got a job in the US and plans to shift in the next 2 months. On one hand, he's enjoying the fact that his dream has come true, but on the other hand, he has no clue what financial formalities need to be completed before shifting out of India. He felt like a sailor who just discovered a new island but had no map to navigate its shores. He heard from someone that if you've stayed in India for 182 days or less than that, now such a person would be treated as non-resident. But he wishes to open relevant bank accounts before traveling. Like an explorer prepping his tools and supplies before setting off into unknown territory, wanting to make sure he's equipped for the journey ahead. This segment will throw light on what all needs to be done by an individual before moving out of India and changing the status to non-resident. Defining non-resident. Calling someone a non-resident is a generic understanding. There are two authorities who define non-resident based on certain parameters. Number one, defining non-resident based on Income Tax Act of 1961. You wouldn't have to worry about this while you're shifting out of India. This rule kicks in while paying taxes or tax being deducted at source. On the other hand, FEMA, Foreign Exchange Management Act, which defines non-resident based on a different set of parameters from that of the Income Tax Act. In this video, we should be looking at non-resident from the perspective of FEMA. A person can be called non-resident based on the following criteria. If you have stayed in India for less than 182 days in the previous financial year, if you are working or running a business outside of India, or if you're going out of India as a student or for any other purposes. Even if you're traveling outside of India for a job, business or for studies, from the very first day you will be treated as an NRI as per FEMA. That means if you have a job offer or a university admission confirmation, that's good enough to set the ball rolling in completing the formalities in banking and investment domain. Let's look at those 10 things that matter the most. Let's segregate the tasks related to banking, investments and insurance. Getting your bank stuff in order before flying out is like remembering to wear pants before leaving the house. It's essential unless you want FEMA playing the role of that neighbor who gleefully points out, hey, looks like you forgot something. The first thing to do is change the regular savings account held by you into a non-resident ordinary or NRO account. It's mandatory that you complete this process because NRIs are not allowed to hold resident savings accounts. It's like changing your shoes when you switch terrains. Just like flip-flops aren't for hiking, NRIs shouldn't use regular savings accounts. Change to fit the rules. Getting your account switched is like assembling that flat-pack furniture. Always some steps and paperwork. In order to complete the conversion process, you need to provide the following documents to the bank. Turning in your documents without self-attestation is like sending a letter without a stamp. Make sure all the documents are self-attested. The resident to NRO conversion form is your address label. Make sure you submit the duly filled in resident to NRO conversion form. Please note that the information shared is for general information only. This might change from one bank to another. The existing regular savings bank account cannot be converted into a non-resident external or NRE account. It's like trying to turn a bicycle into a car. Two different entities entirely. A fresh NRE account has to be opened upon becoming NRI under FEMA. This account is to be opened in person. Like planting a new tree, it requires your hands-on attention from the start. This account can be opened jointly along with another NRI, but not with a resident. Think of it as a dance meant only for those who've learned the NRI steps. Locals have a different rhythm. Please note that the NRO account is meant for managing Indian income. If you have any source of income in India while you are abroad working, say house rent, dividends, interest, etc., such income would be remitted into NRO account. Consider it the local mailbox where all your India-related paychecks get delivered. Even foreign income can be transferred to NRO accounts. But taking the funds from NRO accounts out of India comes with limitations and regulations. It's like a tightly lidded jar. You can put things in, but getting them out requires quite an effort. At the same time, an NRE account is meant for transferring foreign earnings. It's the express lane on a highway designed specifically for speedy foreign transfers. Here, the funds are converted from foreign currency to INR. There's no limit on the repatriation and it follows a very simple process. Like a river, it flows freely without barriers, making its journey back to the sea. If you're looking to invest in India using the earnings from abroad, NRE accounts are best suited since you can take the funds back to the country where you're working without any hassle. It's the ideal suitcase for a globetrotter. Pack, unpack, repack without a hitch. Next, connecting the loan accounts to non-resident accounts. You might have current loans going on, especially home loans. Once your residency status changes to non-resident, you can only repay the loans via NRO or NRE account. Once your savings account has been converted into an NRO account, you can set up a new ECS mandate for repaying the loans. You can make a smooth transition in case of repayment of the loan and avoid potential default in loans. Appointing a power attorney to do tasks for you legally, like saving the day while you're on a different mission. For instance, imagine you want to buy or sell property in India, but you're sipping tea in another country. Your power of attorney is like your real estate sidekick making deals in your name. Think of the power of attorney as your special instruction manual. You're the author writing down what your superhero sidekick can and cannot do. He or she is a legal authorization given to another person. The authorization powers are well defined and clearly covered scope decisions which can be taken by the person who's authorized. One important thing, register your power of attorney. It's like getting a stamp of approval to show it's real. Just visit the local sub-registrar office in the jurisdiction closer to you where all the legal stuff happens and you're good to go. The first question that needs to be answered is, can non-residents invest in Indian equity or security markets? The generic answer is yes, non-residents can invest in Indian equities, bonds, debentures, government bonds and ETFs. A non-resident has a choice to open two types of accounts. Number one is Portfolio Investment Scheme or PIS account. Number two is non-PIS account. In order to start investing in equity markets in India, a non-resident can open a Portfolio Investment Scheme or PIS account with a designated branch of any bank recognized by the RBI. It's like unlocking a special door to a treasure room, but you need a unique key. Permission letter is needed from the RBI to open a PIS account. Now, this account can be funded via both NRE, which is easily repatriable, and NRO, non-repatriable or repatriable with restrictions. Think of it as needing a golden ticket to enter an exclusive party, and you can either come in a limo, NRE, which is, and a taxi perhaps, which is NRO. Even though all the major banks provide a PIS account facility, only limited branches provide this facility. For instance, if you look at HDFC Bank, PIS facility is offered only at 11 branches across India. Basically, one branch per city is designated as a PIS service provider. It's like every major city having a gourmet bakery, but only select branches bake the rarest, most sought after pastry. Opening a non-PIS account doesn't need permission from the RBI. Please note that if the money is invested through NRO account into a non-PIS account, funds from that are non-repatriable. It's akin to signing up for a basic gym membership without any frills, as opposed to the VIP package that has special privileges. Remember, NRIs cannot do short selling. Non-resident investors have to take delivery of shares purchased. Non-residents can invest in futures and options from the rupee accounts held in India on a non-repatriation basis. It's like a guest in a foreign land who can buy souvenirs but cannot just borrow and return them. They need to own what they take. Existing shares held in the resident demat account should be transferred to a new PIS-linked demat account. And make sure you change the residential status in your demat account as well. Imagine moving your precious gems from one safe to a new one, specialized vault which is tailored for your special needs. Public Provident Fund or PPF is like that reliable friend who brings the best snacks to a party. Issued by the Government of India, this fixed income security is a big hit. Not only does it boast of the most attractive interest rates, that too completely risk-free, but it also has got that dazzling tax-free sash wrapped around it. And wait, there's more. You also get to flaunt a tax deduction under Section 80C up to 1.5 lakh rupees. It's like the triple-layered chocolate cake of the financial world. Now for our NRI friends out there. Ever thought about sneaking into this PPF party? Unfortunately, the bouncer at the door, aka the government rules, say no entry. But hey, if you've partied, in this case opened a PPF account while you were still a resident, you can keep rocking inside. Think of it like being the DJ of the party. Once you're in, you keep the beats going. If you're considering moving abroad but still want to be boarded onto the PPF boat, get your groove on now by opening an account before you jet off and become an NRI. Open a PPF account while you're still a resident Indian, and remember, just like that song that never seems to end at the karaoke, the original term of the PPF account lasts for a whopping 15 years. But once that tune's over, no encores. You cannot extend its term. And it's a strict lights out at the end. You must close the account upon the original maturity. Lastly, to claim your party favor, aka your money, just hand in your PPF withdrawal slip with some ID proofs and slide those funds into your NRO account. It's like ordering a cab after a night out. Always best to be prepared. Alright, Globetrotters, fancy going international international but still want a slice of the Indian mutual funds pie? Well, you're in luck. Just like ordering your favorite Indian dish from anywhere in the world, non-residents can totally invest in mutual funds in India. Got your SIPs or other systematic plans running? Think of them as your recurring order for butter chicken. They keep coming even if you switch the tables or countries. Now for the fun part. For mutual funds, you'll need to give your KYC or know your customer records a little bit makeover. A bit like updating your profile picture when you move to a new city. Change that status from resident to non-resident. And here's the insider tip. KYC records are like the social media of the finance world. Everyone's speaking. So you just have to walk into any investor service center or ISC, basically a branch office of any AMCs or registrar and transfer agents office like CAMS or Carvi, etc. However, there's a tiny catch. You can only flash your non-resident badge after you've truly earned it. That is, after spending more than 182 days abroad in a financial year. It's a bit like waiting for your official fan club membership to arrive. And if you're in a rush, remember you cannot pre-update before flying off. But just like sending a friend to grab your spot in a queue, you can use a power of attorney to complete the formalities once you're officially a non-resident. Now for our friends from US or Canada, there's a slight twist in the plot. Some Indian mutual funds are a bit exclusive, like those fancy restaurants with super specific guest list. They might not let you invest afresh, but hey, you can still sit at the table with your earlier investments. And surprise, surprise, some mutual fund companies might even roll out the red carpet for further investments. Last but not the least, remember FATCA, especially for the NRIs from the US or Canada. You will have to be compliant with FATCA, Foreign Account Tax Compliance Act, and provide the necessary information. Remember to share the correct set of information, since the entire set of information is shared with all the necessary foreign agencies, Indian tax authorities, and regulators. Next is real estate and the assigning of power of attorney. Ever noticed how most of our financial stuff in India has hopped on to the digital bandwagon? Yep, it's a breeze online. But when it comes to playing the real estate game, it's a bit like trying to assemble a massive jigsaw puzzle without the picture on the box. It's hands-on and can be a tad challenging. This is where a superhero move comes in handy, appointing a local buddy with the power of attorney. Think of this as giving your trusted sidekick a special pass to help you with the nitty-gritties. Renting out your place? They've got it. Tangled in the web of paperwork or sealing the deal on a property? They're on the case. And the awesomeness does not stop there. If your POA buddy has the right permissions, they can even wear the financial cape, helping you out with tasks like filing of your income tax returns, managing your bank accounts, and keeping up with all the rule-following stuff. So in the big adventure of real estate, it's always great to have a local superhero by your side. Heading abroad means more international calls and perhaps less spicy food. But remember, someone's still back home in India who may be binge-watching Bollywood minus you, or your parents who are now hip with TikTok. Well, they might still need your financial support, and life insurance, especially a term plan, is like that trusty umbrella for unpredictable monsoons. Getting term life insurance is like placing a soft, reassuring cushion beneath them. And here's a thought, you might be planning to come back to India in the future. For example, if you're working in Gulf countries, you won't get the residential status. Most of these people tend to come back to India at some point or the other. Concerned about the non-resident tag? Fear not. It's no hurdle when it comes to life insurance in India. Just keep the insurance folks updated if you switch your addresses. Typically, your premium stays constant. However, if your new place screams adventure or high risk in the insurance lingo, there might be some tiny tweaks. Plus, the payout from the policy is tax-free, so you're set wherever you jet off to. So as you pack for your next big leap, think of life insurance as that reliable travel buddy, ensuring you're all set for whatever the journey brings. Ever heard of India being a hot spot for medical tourism? It's not all about spicy curries and Bollywood dance numbers here. India's health sector isn't just blooming, it's booming. People aren't just flying in for our Instagrammable landmarks, but also for a bit of TLC in the medical department. Why? Imagine top-notch care but without burning a hole in your pocket. Sweet deal, right? Let's say you're an NRI flying away to far-off lands, but leaving some heartstrings and family members tied to India. They might be floating around in those family floater medical insurance plans. So even if you're shaking a leg abroad, it's a smart move to keep that medical insurance grooving in India. Why? Firstly, those premiums. Super budget friendly compared to many dollar dropping countries. But here's the plot twist. While Indian medical insurance throws a grand party, it mostly keeps it local. Catch a cold abroad, the bill's on you, pal. Unlike the life insurance, medical insurance has geographical limitations. Most of the general insurance policies issued in India are covered only in India. Medical expenses incurred outside India generally are not covered. Also, if you're thinking of hopping on the insurance train later in life, be wary. Pre-existing conditions like diabetes and heart diseases may not be covered under medical insurance for the first couple of years. In fact, in some cases, the insurance might even reject the application for medical insurance coverage to an individual with a pre-existing condition. It would make sense to buy a medical insurance plan at an early stage of your life. So while you globetrot, remember, Indian health insurance is like that reliable buddy who's got your back, but mostly in the homeland. Plan wisely and dance on. If you have good medical insurance coverage already abroad and you have no plans for shifting back to India, in such cases, you might have to have basic coverage plans while you're visiting. You can look for a top-up or a super top-up plan without a base coverage or deductible. The claims would be paid over and above the deductible limit. It only comes into play when the weight of the fall exceeds the basic net strength. Generally, these policies are cheaper compared to regular health insurance plans. Like buying extra strong thread instead of a whole new net, these top-ups usually cost less, yet they reinforce your protection whenever needed. Hey, so if you've made it to the end of this video without falling asleep, kudos to you. We hope our info session sprinkled some wisdom your way. Just remember, one size doesn't fit all, especially in the ever-twisting maze of regulations. While we've given you a general roadmap, do not forget to peek at the specific signboards for your industry and company. Always good to ensure that you're on the right track and not heading into "oops, I missed that turn" territory. Stay savvy and keep growing.